have me. So you guys, for the ones that you just joined, if you're not doing this already, you see a live button on the right to my name, and that's for you to join the stream. And then when I'm done, you're doing the same thing, so you can join key and screen. And you can let me know when I'm good to go. Okay. Hi guys, this is Jonathan from Owls Investment Group. I will be reviewing today some basic chart patterns, and I'm gonna have a second lesson on this next week or the following week. And right now I'm gonna do some of the most important ones, and I'm gonna go a little bit more deep into it next class. And after that, Kian is going to review with you guys the Greeks and options and how can you review those and use them in your favor when buying an option contract, or what do you need to know so you don't lose money for buying the wrong option contract. And he's going to review some financial things as well for stocks more than options. So let's start. Chart patterns. So the first one we're going to look at is the head and shoulders formation. So the head and shoulders communicates market activity and the balance between buyers and sellers. It's best off during established trend, which means consolidation. Indicates a trend of reversal. That means that when you're looking at patterns, whether you're looking candlesticks or charts, first thing you gotta ask yourself, this is a continuation, a breakout, or a reversal. So make sure you are aware of those things. In this case, we're reviewing a reversal. By that, we mean that in the case of the head and shoulders, we're having an uptrend that is going to reverse in a downtrend, where the reversal comes. The head and shoulders confirms the structure by setting higher highs. The right height of the shoulder is the first lower high point. The neckline connects the lows of the correction wave. So the neckline is the support. What do we mean by this? This is a QCOM. All these charts are from today. This is a QCOM 20-day 1-hour chart. This blue line at support will be the neckline. The left shoulder will be this one here, this high. The head will be the highest height, and the right shoulder will be the lowest height. So you see here, the head confirms the structure by setting higher heights. That's the head, and that's a higher height. The price wave at the left shoulder. So you see the left shoulder and the price starts dropping. It's setting support close enough. Something that you need to know, all these patterns, they don't have to be perfect. Like nothing in the market is perfect, at least 99% of the time. That's a number that I'm making up. But yeah, as long as it accomplishes the requirements, which is the price wave at the left shoulder. So left shoulder, price start waving. It's also a reversal. That's another requirement. So you see an uptrend, and then it's reversing to a downtrend. So we got the left shoulder, a high to a wave, reversal pattern. Then we have the head that confirms the structure by setting a higher high. So that's the head. So the third requirement here. And the right shoulder is the first lower high point. What's a lower high? So we got a correction here. We got a high. However, it's a lower high on this pattern here. You see, this is a higher high. This is a lower high from this higher high, but it's still higher than this one. So this is the lowest high between the left shoulder, the head, and the right shoulder. We're gonna have this as a lower high. Then we have the neckline, which is the support. And once we break this neckline here, the pattern gets confirmed. So just to recap on this, This is a head and shoulder. It's a reversal charting pattern which goes from an uptrend to a downtrend. It happens during consolidation. As you guys see, there's consolidation here between these two, the neckline and this high. And we need a left shoulder. If the price after setting a high, we need a head, which is going to be your higher height. And we need a right shoulder, which is going to be your lower height. And once we pass the neckline, we confirm our pattern. So this would be either your entry for shorts, in our case, the ones that we trade options, or entry for puts, or a stop for your calls, selling point. Okay, so that's your head and shoulders. If you have any questions, we can have those at the end. Now we're going to look at the cup and handle. So often preceded by an upward trend. So this would be the beginning of the upward trend. The price falls when it forms the left half of the cup. The right half of the cup shows the initiation of an uptrend once again. When the price returns to its high, forming the left edge of the cup, there is usually not a direct breakout. Instead, the price drops again for a short time and the cup and handle is formed. So, okay, let's read this. The handle indicates a brief correction before the upward breakout. So that means here, again, this doesn't have to be perfect. You see how this looks, like a little cup? So we have a resistance here. We have our first sign of an uptrend is this and this reverse here. However, once we get to this height, we stop for a small correction, and then the breakout is where we want to get in. This is our entry point here. So you guys see here, the right half, the price falls when it forms the left half. So the left half is this one, starts here, the price falls. So that's our left part of the cup and handle, or the left half. We got a high, we set our resistance level, price drops, we get a low. As far as right now, we have this. Now the reversal uptrend starts. So the right half of the cup shows the initiation of the uptrend once again. So we were on an uptrend here. See, now once again we get the uptrend going again. And after the price returns to its high, which in this case not the exact same high, but is close enough, we can still use it. Ideally, it wouldn't be at this high, but as I say, none of these patterns are going to be perfect. So when we return to a high that is close enough, instead of just breaking, we have a small correction, which usually, if the uptrend recovers, that means that it's going to recover with more strength. That's where we get the breakout, because and we were talking about this morning about Jumia. Jumia was trying to find a cup and handle on the 5-minute chart this morning, and it stopped at resistance and it started dropping. So we were, if we can find a cup and handle, we didn't use the word cup and handle, but what we were talking about, that's going to be good, because after the small correction, there's going to be more power for the uptrend. It ended up just dropping, so the pattern never confirmed. But that's the idea of the cup and handle, that you have an uptrend, you have some drop at resistance, the uptrend tries to come back, and after a small resistance, you get a breakout, and it's usually strong. This is the Apple chart for today, 12:15, 12:30 p.m. Pacific time. And this is a 10-day, 30-minute chart. So the handle indicates a brief correction before the upwards breakout. You see, big correction before the breakout. Often preceded by an upward trend. So that's our pattern here. And as you see, it's preceded by an upward trend. Leave this so you guys can read it. And I will share this presentation with you guys. So that's our cup and handle. Now let's go to ascending triangle. This is one of my favorites personally, especially for swings. Trend continuation formation during an upward trend. Okay, so what did I say at the beginning? Be sure you know if it's a breakout, which is the cup and handle is a breakout pattern. Be sure you know if it's a reversal or a continuation. So trend continuation formation during an upward trend. Buyers still overwhelm the sellers. Price always returns to the same high. Sellers do not have interest on bringing the price down to the lowest low. So there's a lowest low set that is never coming back. We do drop at the same high, however, we keep forming higher lows, which means that we are steadily climbing and we just need the buyers to push or the sellers to stop showing up for that price to just go the uptrend. The most important part of the ascending triangle is that the lows show an uptrend by forming consecutive higher lows. That's what I just said. So we want to make sure that we look at that. That's what an uptrend is. An uptrend is usually formed by higher highs or higher lows. In our case, we're going to have the same high before the breakout or the continuation, but we're going to have higher lows. That means we're in an uptrend because we're forming consecutive higher lows. And as I said before, if the sellers step out, there will be a major breakout once resistance is passed. This will be the entry point for I forgot to put here for long in the case of options for calls. So this is a sun run chart, 30 days, 2 hours, also 11/9, so that's November 9th. So we start November 9th here, and this is actually from today. No, it's from last week, I think. All right, it doesn't really matter what date is, as long as we have the pattern and we can make an example. So what do we got here? We got a low, and we got consecutive lower highs. We have a higher point here that is not ideal. Ideally, we don't want to see this, but as I say, these patterns are not always perfect. As soon as you visualize this high here and this high here, lower low and consecutive lower highs. Then once you pass resistance, you get your entry point. And you see it takes you all the way to from 60.56 to 69. So it's a pretty healthy run. It'd be a good entry point here. As I say, I like to look at this chart for swings. So everything above the hourly chart will be good to draw this pattern. So we'll review it. Ascending triangle, trend continuation, forming during an upward trend. We know it's an upward trend and we do a continuation. You see this was an uptrend here, small correction, forming a new low. And then the uptrend just continues until the breakout. Watch how the downtrend always keeps losing steam until you finally have the whole breakout. Buyers still overwhelm the sellers, as you see here. Buying power here, there's some sellers, buyers, some sellers here. This was probably the biggest drop. But after we hit this low, the second low, which is a higher low than our support at 49, the buyers just constantly and overwhelming them. You see these candle wicks, like you see that how we're pressuring here. Look at the size of this candle. No, barely any reversal here, candles, and keep forming lower highs, higher lows in this consecutive until we finally reach the resistance, and this is where we're either gonna drop or we're gonna confirm the pattern. So that's our ascending triangle. Also, before I forget, there's also the descending triangle, which is the same concept, but it's the same concept, but instead of looking towards the uptrend, it's going to be towards the downtrend. So instead of forming higher lows, you're going to form lower highs, and it's going to break out a support for the continuation of a downtrend. So it's pretty much the same concept, but you apply it for a continuation of a downtrend instead of a continuation of an uptrend. And you're going to have the same low, but always you're going to have lower highs. And that would be a descending triangle, which is going to be the opposite of the ascending triangle. If this is an ascending triangle. Okay, yeah, that you can use that as an ascending triangle. You see, it has, if you guys go in the premium chat, actually, let's take a picture of this and I share it with you. So this is from Nate. So that's a screenshot from Nate. Actually, I can drag it here, but if you guys go on the premium channel, you should be able to see it. It's not letting me drag it to my screen. No, because I'm on a presentation. Yeah, Nate, that's an ascending triangle. You have the same high and you have consecutive higher lows. So that's it. So if you break that resistance, you will confirm your pattern and it could be an entry for calls. And what time frame you're looking at? 2 hours. So okay, you're looking at the right time frames. Always look at the hourly at least. Yeah. So that's good. If you guys want to see an example, look at Nate's chart, the premium chart. All right. So, and again, you can have a descending triangle, which is lower highs. Yeah, SID2, same thing, ascending triangle. You have a resistance, which is the red line, and you have constantly higher lows until that breakout. Good example. All right, and we move on and we go to the double and triple top. This is one of the most common patterns, but it is common, but a lot of people get them wrong. And actually, they're not too hard to figure it out. And it could be a great example. This is a reversal too, but it's from a downtrend. Can it be still ascending triangle without breaking resistance? It's forming a triangle, but it's not confirmed yet. So after breaking that resistance, your pattern will be confirmed, and you're going to have your entry for a long, which in our case is a call. So yeah, you see the triangle, but one away for your confirmation. Okay, once the pattern is confirmed, you can entry. You're welcome. Double and triple top, most common formations in technical analysis, easy to misinterpret. Price repeatedly tries to break the last high during an upward trend. The price fails every time and it's pushing down multiple times. All right, that's unmute, guys. Please make sure you guys are muted. The resistance ideally is the same level. I mean, you can have some candle wicks that are going to overpass, but you always want to see the same high. You want, of course, otherwise it wouldn't be a flat line.
Universal true purpose. Chef Patricia has done that tonight by opening.
Yeah, you guys gotta make sure you mute because that's not. The price fails every time and it's pushed down multiple times. This translates into a lag of interest by the buyers and increase of interest by the sellers. As we say, this is a reversal pattern and it's from the downtrend, so you're gonna see the sellers overwhelming the buyers. So if the sellers overwhelm the buyers, a new downtrend begins. Hence, this is a reversal pattern. That's just what I say with different words. If the price breaks the lowest point, the pattern is complete. So a 5-day, 5-minute chart from Snapchat. You see here we have a resistance, a 1, 2, and triple top. We have this support here. So after the third top, we break support and we start a downtrend. And it's a reversal because we came from an uptrend. We consolidate and we reverse. That's two. That's also, if you guys see it, that's an example of a double top. And once it broke that 150 level for Walmart, 150, what I see, it confirms the price or the pattern. So I think that's all I have. Let's recap the triple top and make sure we have everything that we need. So price repeatedly tries to break the last high during an upward trend. We have an upward trend, the green candles here. We have the same high, 1, 2, 3, even 4 times here. In this case, I just want to use these 3 here. But the idea is the same. And again, they're not going to be perfect all the time. But as long as the main requirements, once again, should enter once it breaks support. So this is not an uptrend pattern. This is a downtrend. So once you break support, if you're long, you might just cut your contract if you have a call or a long contract, or you might enter short because you can just get this high. And eventually, I want to go through the charts that I picked, and I want to take like 5 minutes to put the patterns together and what do I see on those. That's what we're going to do right now. We got the first head and shoulders formation. We got a Q-com. So we got an uptrend here. We got the left shoulder before the wave. We got the head, the highest high. So once you get, for what I see, once you get this lower high, you can interpret that something is not right with the uptrend anymore, that lower high is definitely to take into consideration. So we got first here, this high. We got a little bit of a confusion here that drags the price down. Then we got a higher high, and we got a rejection all the way to support. And if this would be a higher high, then you're like, okay, we continue the uptrend, but the uptrend is broke. Once you get a lower high, the uptrend is gone right now. If here you have a correction and you get a higher high, then you have, again, a new uptrend. But since you're getting a lower high, that's it. You don't have an uptrend anymore. And what happens when you don't have the uptrend anymore? You either wait for a consolidation and a break on either side, or you just wait for a break of support, confirm your pattern, and go short. So that's what I see on that chart. The cup and handle, I think we went through this one pretty clear, but I go one more time. So you have a high, great, see, yeah, cup and handle, that's good. DraftKings. So you have a high, then you can break the high, so you form a bottom. Now you have the uptrend trying to form again, but right before resistance, or right at resistance, it gets a small rejection and it forms a correction, but it forms a higher low. So you see, which confirms the uptrend. Now you just need a push from the buyers to break that resistance finally, and that's going to set a new price high. So that's what you climb. You get the rejection here, some correction, trying to form a downtrend. However, you find a bottom here. You form a high, close, but at the same price of resistance. You form a new low, which is going to be a higher low, which is going to confirm the reversal here. The new uptrend is going to continue the uptrend. And once you break resistance, your pattern is confirmed, and you can go long, or in this case, calls. triangle. We went through this one too. We have this high. We try to break it here, 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 and we keep forming. We form a low before forming our high inside our resistance, and then after that low, just means an uptrend because we're getting consecutive higher lows until we break resistance and the buyers overwhelm the sellers, and we get a run here. And we went through this one. We get this high. We can get through this high. It's like a wall. We can push. Then after the consolidation happens, it's expected that we can drop. That's why this is one of the most common patterns, because we have an uptrend. We try to push. And at some point, there's just too many rejections. That price can just go through. So what's going to happen? You can either have a big consolidation, or if it breaks your support, it's most likely going to form a new downtrend, sorry. And this is a triple top. There's a double top, and there's also triple and double bottom, which it'll be the same case, but instead of forming a reversal from an uptrend, it'll be a reversal from a downtrend. So you're going to have 2 or 3 bottoms. You're going to have a support. After rejecting that support multiple times, 2 or 3 times, you will be looking for a test on resistance. And once resistance is break, you're going to have your double bottom or triple bottom confirmed. So next class, we're going to study the wedge. Wedges are similar than triangles. We're going to go through a classical wedge, and we're going to see how we can use a wedge as a continuation pattern. We're going to go on trend lines. So this is going to be fun. This is one of my favorite things to do. We're going to go into trend line angles and how to do confluence. So that's going to be for next class. You guys have any questions before Kian continues?
Nope.
Are we all pros at it now?
What's that?
We're all pros at it now, huh?
Yeah.
Yeah.
Also, you can find this stuff on the internet. It's not a secret. It's not something that what I do want to get into it this next class is going to be drawing the trend lines and confluence. I think those things require a little more experience and work. This is just basic stuff that you should be able to recognize this. It's not that hard, but I mean it's also good to know. Like, you don't know it until you get exposed to it. So, but definitely trend lines, trend line angle, and confluence are good stuff to learn. So either next class or the class after, we're going to do this. But we're going to continue this session for sure. And the wedge are also good. They are similar than the triangle. Yes, you can spot patterns in all time frames. However, if you are trying to a little more confirmation and have a stronger level, you should do it in hourly charts. The only one that I recommend do it in smaller time frames is the double and triple bottom and the double and triple top. Otherwise, the other ones should be able to. You should try the other ones on hourly charts. It's just going to give you a stronger level, some more reliance. But yeah, you can do the bottoms and tops using shorter time frames, like 5 minutes, 15 minutes. And if you guys have any more questions, Kian, whenever you want. Thank you for your patience and being here.
Thanks.
That was nice.
Thanks, Elkin. Let me change my screen.
All right, now. So you guys going to join Kian's stream right now.
Yep.
Stop me, and I'm going to mute myself. Also, we can talk about it at the end of the session.
Oh, I'm sorry. Gotta do this. I'm trying to fix the OBS first. And then I will. Why is it? There we go. Okay, so there's that. There's that. Now Discord. All right, let me know when you guys can see my screen.
We can see it.
You can see it? All right. So today's subject is going to be on the Greeks, our favorite. So let's get started. So delta, one of my favorites and one of the most important. So basically, it's the measurement of the speed at which the option price changes relative to the underlying stock price. When you look at the option chain, when you look at the delta, either on the calls or puts, on the call side, the deltas range from 0 to 1. Okay. The delta puts range from 0 to -1. So on the put side, the deltas are negative. On the call side, the deltas are positive. So for example, for delta, if Apple is trading at $129, let's say the January 130 call has a delta of 0.40. So if Apple goes up $1 to 130, the option should go up 40 cents. Okay? So delta basically means the percent chance of finishing in the money as well. So that same delta above in the example is considered to have a 40% chance of expiring in the money. Okay? So delta changes over time regardless of a move in the underlying. So as the expiration approaches in the money, the option moves closer to delta 100 and out of the money options get closer to delta 0. So as you notice, when your stock, when your contract is getting closer to the strike price, you're making a lot more money, right? Because your delta is increasing. And when your stock, your option contract is getting further out of the money, your delta is decreasing and losing value. And remember, today's delta is not tomorrow's delta. So today's delta could be, for Apple, could be 0.4. Doesn't mean tomorrow is going to be 0.4. It could be 0.3, it could be 0.5. So remember, today's delta is not tomorrow's delta. For swinging, I find contracts with 40 delta or more. Okay, I like to have a cushion. I like higher delta. They're going to cost you a little more, but that is my rule of thumb with a delta of 40 or more. Gamma. This one I don't really utilize, but we're going to learn it obviously. But it's not something that I really focus on. But in basic terms, it is the odds of a change in the probability of the position expiring in the money. So the odds of a change in delta. It's an early warning to the fact that delta could be about to change. Calls and puts both have positive gammas. Deep out of the money and deep in the money options have almost a 0 gamma because the odds of a change in delta are very low. And basically it shows us how fast our position delta changes in relation to the market price of the underlying asset. I honestly don't really use gamma. As long as my theta is low and my delta is high, that's honestly what I care about. Speaking of theta, so theta stands for the option position sensitivity to time decay. Long options have negative theta. Every day you own that option, time decay is eroding. In other words, time decay is hurting the position of a long call option. Okay, so they're saying calls, right? So when you're in a calls, you have time decay, right? Every day your contract loses value. When you short options, theta is positive. Time decay is actually helping the option writer's position. Okay, so when you're writing puts, theta is going to be positive. So the closer the expiration, the higher the theta, and the farther away from expiration, the lower the theta. That is actually vice versa. My apologies. That's vice versa. The closer the expiration, oh, I'm sorry. No, that's right. The closer the expiration, the higher the theta, And the farther away from expiration, lower theta. More time, less theta, less time, higher theta. Vega. Vega is the option position sensitivity to volatility. Options usually increase in value when the underlying stock's volatility increases. Volatility helps the owner of an option and hurts the writer of an option. It is positive for long option positions and negative for short option positions. So remember, long calls, negative, or short is puts. IV, very important as well. An estimate of the future volatility of the underlying stock based on the option prices. Option IV can help serve as a measure of how cheap or expensive it is. IV increases ahead of an upcoming announcement or an event like earnings and decreases when these events pass. So when you hear, when we say IV crush, right? So before earnings, IV is much higher, right? We're expecting a big move, for an upcoming event. But after earnings, there's an IV crush because that event has passed. So the volatility is how much a price moves over a given period of time. So high volatile stocks, large price movements. Low volatile stocks, none that, some that, does not move as much, right? So, as we can see, Tesla, right? Tesla has an IV of sometimes 150%, 175%, because that stock moves so fast, right? And big, it goes from a $20 move, $30 move. So you're expecting big price movements. Low volatile stocks like Pfizer that doesn't move a lot. The IVs can be very low, 20%, 30%, maybe 40% sometimes. So obviously the higher volatility stocks are more risky as well. When you play Tesla, your contract can move very fast. If the stock doesn't go your way, you can see your contract decreasing in value very quickly. So stocks that trade between $20 to $30 over a period of time it's more volatile than a stock that trades between $24 to $26 as an example. So those are the Greeks. Again, theta, delta, and IV is the most important. For me personally, the higher the delta, the better. When I go into long positions, and obviously when we put time on our contracts, the theta is lower, so we don't have to worry too much about time decay. And IV, obviously we play Tesla, high IV could be good if we capture on the right side, right? Yeah, the right side. But then again, it can hurt us as well. But stocks like AMD has very low IV, so your stock doesn't move as much. Your option contract doesn't move as much. So those are the three that I really focus on. So a little bit into fundamental analysis, evaluating investment prereqs. So before investing, you should be able to provide necessities, housing, food, transportation, taxes, clothing, etc. These are the main things you should have before putting all your cash in the market to invest. So you need a minimum cash reserve for emergency purposes, adequate insurance against lost income or property, as far as health, life, liability. And only after establishing these prereqs can you clearly define financial investment goals. So once you have all these in line and you have a certain amount of money that you can invest safely, that's when you can start building your portfolio. So step 2 is establishing goals. So investment goals are specific statements of timing, size, form, and risk. So these are associated with the desired return being sought. So common goals, building up funds for retirement, enhancing current income, save for major expenditures, shelter income from taxes, obviously sign for Roth IRA, those kind of accounts. Writing an investment plan. So for each goal, specify the target date for achievement and the amount of tolerable risk, right? And the more specific you can be in your statement of goals, the easier it will be to establish a written investment plan. Obviously the young investors where we have a much higher risk tolerance, it's more like, hey, I'm going to invest in all these growth stocks. The Teslas, the Zooms, the Pelotons, all the stocks that have the high PE ratios. Where you got time, you can risk more than someone who's situated, who has a family, mortgage, etc., where they can't risk an X amount of money on these type of stocks. So make sure to have these plans that fit your goals. And then step 4, evaluating investment alternatives. So the potential returns and risks associated with investment alternatives must be assessed. The assessment process is referred to as evaluation. We'll get through that. And one of the main things I always, talk about for long-term investment is diversifying your portfolio. We all hear this, do not put all your eggs in one basket. So the performance, risk, and return on the selected group of investment vehicles is likely to differ substantially from the performance of individual investment vehicles making up the group. So, I get questions from my friends, why can't I just put all my money in Apple and Tesla? Okay, I get those questions. Well, let's just say Apple is down 7%, Tesla is down 15% that day, or for, a good amount of time. Your account is down big time and you're going to start worrying, right? You're going to start thinking, oh my God, like I need to sell, I need to take my money out. This is, I'm not diversified. I put all my money in 2 stocks and who knows what's going to happen. Rather than investing in, having some money in the banks, financials, having some in technology, having some in biotech, having some in cyclical stocks, consumer goods. That way, those stocks offset other losses of other, sectors. Technology could be down one day, but consumer goods could be strong, right? So it's offsetting your unrealized losses, right? So always have a diversified portfolio. Don't put all your eggs in one basket. Don't put $10,000 in just Tesla stock thinking that you're going to triple 10,000 in the next month. It's the worst thing you can do. And managing the portfolio. After constructing, constantly monitor the performance of the portfolio to ensure that actual performance is consistent with expected performance. If not, you will need to make changes to the investment portfolio. This may involve selling some investment vehicles and purchasing others. So, for this example, this kind of, leads into, return on investment, right? So, for example, I bought 280 shares of SunPower. Okay. And, as I'm looking through my long-term portfolio, so I bought 280 shares of SunPower at a purchase price of, $12, right? So, right. And then, today it went up to 24. What I did was I took out 140 shares of it. That way I get my return of investment back, right? And now I'm writing the rest for free. So you got to manage your portfolio. You got to see, what's, performing well, what's underperforming, and, create a strategy. Should I sell these, growth stocks to put into more safe stocks? Should I do vice versa because I can tolerate more risk? I usually, manage my portfolio maybe, once every 3 to 4 weeks. Okay, I don't really look at it too much. Because if I look at it too much, then I'm gonna get worried. I'd rather look at once a month, or maybe once every 3 weeks, and make sure that they're performing well and it's in line with my my investment goals. Do I have to add? Do I have to sell? Do I have to average? So always manage your portfolio. So stock picks. Stock picks are based on fundamental or technical analysis. Since we are focusing on fundamental analysis, we are looking at the company's operations and profits. So, in today's market, intrinsic value is kind of tough, right? Because companies' PE ratios are sky high. Okay, so these evaluations are going to be a little crazy. But for example, when you're doing an intrinsic value, let's say you pick a stock, right? You're going to use Yahoo Finance. I mean, these information is all public. You're going to find the earnings per share trailing 12 months. Okay, then you're going to get the growth rate of the next 5 years. Okay, for stable companies, you're not going to get one for I think Tesla's gonna be a hard one to find, but just usually like Apple, Microsoft, Coca-Cola, those type of companies. You can use your own judgment, or you can just go on the analyst tab on Yahoo Finance. And then you're gonna pile up your minimum rate of return. And when you're investing, you obviously want a higher return than the S&P 500. S&P 500 gives an average return of 8 to 9%. So what I like to do is using 14 to 16% minimum rate of return, right? And after that, you're going to collect margin of safety. The ideal number is 40 to 50%. So the bigger the margin of safety, the less risk. So basically, margin of safety is a built-in cushion allowing for some losses to be incurred without taking a major negative effect. So, it's just a safety net, basically. So once you have that down, you're going to get the PE ratio. How much you think we can sell the stock for in the future. Okay, so when you do the calculations, you're going to multiply the growth rate by 2, or you can use the historic PE ratio, the financials analysis, and the price ratios, and then take the average of the 5-year high and the 5-year low. So once you have those down, you're going to be forecasting what the earning of the stock is going to be per share in the future. Use figures that you have filled out previously. So 1 through the figures that we just did before. And you're going to start from year 1 to year 10. And you're going to start with the current earnings trailing the 12 months. Then multiply from growth rate for the next 9 years. Once you get to year 10, earnings per share trailing 12 months will be multiplied by the PE ratio, which equals the estimated share price in 10 years' time. Okay? To get the fair value, it equals 10-year share price divided by 1 plus the minimum growth rate, then work all the way back to year 1. And this is an Excel sheet that I'm going to send you guys with the formulas. Last but not least, do not buy shares at the fair value. You're going to multiply that by your margin of safety. So price ratio analysis. It's one of my favorites, but I do not rely solely on the strategy. The price per earnings ratio, or PE, which is basically the current stock price divided by earnings per share. The higher the PE ratio, the investors are willing to pay a higher share price today because of growth expectations in the future. Low PE ratio, company could be undervalued or is doing very well relative to its past trends. So obviously, Zoom, high PE ratio, Coca-Cola, low PE ratio. Earnings per share is yearly profits divided by average number of shares outstanding. Earnings yield is earnings per share divided by the current stock price. And again, growth stocks have high PE ratios, value stocks have low PE ratios. Earnings and cash flow analysis. Cash flow is a corporation's lifeblood, the primary source of earnings. Despite that the relationship between stock price increases and cash flow is very strong, to understand cash flow and earnings, investors like you guys need to have a basic understanding on how to read financial statements, which includes the balance sheet, income statement, and cash flow statements. So the balance sheet is based on the fundamental accounting equation, assets equals liabilities plus equity, stock. So assets have 4 major categories. So current assets, this is cash, inventory or things that can be converted to cash in a year. Fixed assets, life of greater than a year, can be tangible or intangible. Investments, securities held for investment purposes, and other assets, miscellaneous assets that don't fit in the other assets. The balance sheet still has liabilities, which have 3 major categories. The current have to be paid within a year, accounts payable and taxes. You accountants who are in here, you guys can go way in depth with that. I don't even get into that kind of stuff. These are just the basics for the finance guys. Long term includes notes, bonds, and loans with maturity that are greater than a year, and other miscellaneous items not belonging to any other liability category. Then we have shareholder equity, difference between assets and liabilities, which includes paid-in capital, meaning amount received from issuing stock, right? And retained earnings, cash saved out and not paid in dividends. The income statement. So the income statements measure the operating performance during an accounting period, either on a quarterly or annual basis. Net income is the outcome of the income statement and represents what the company generated during that period after subtracting costs of goods sold, operating expenses, interest expenses, and taxes out of the net sales. Statement of cash flows. So the categories included in cash flow are operating cash flow, which measures the amount of cash generated by a company's normal business operations, investing cash flow, cash generated or spent relating to investment activities, and financing cash flow, loan made to a company which is backed by a company's expected cash flow. So net income is equal to cash flow because net income contains non-cash items, right? So operating cash flow adjusts net income for non-cash items as well. So the performance ratios, what we look at, these ratios include gross margin, which is gross profit divided by net sales, operating margin, which is operating income divided by net sales, return on assets or ROA, net income divided by total assets, return on equity or ROE is net income divided by stockholders' equity. And whoever uses TOS, this information is all included in the fundamental tab on the TOS application. So when I look, when I research companies, these are the kind of the steps I take, right? So the first thing I do is I go in the business section of the 10K report and understand what they're doing. What is their company all about, right? So after that, I go to the management discussion and analysis, right? The MD&A. And these are posted in their quarterly and the annually reports on their website, their investor relations website. And that includes business overview, what are they doing overall, management's plan, who's running the company, who's part of management, who's going in and out, the industry and the industry trends, what's going on in their industry, how is it performing, what's their valuation in the next 5 years, segment performance, and overall performance. Then once we have those down, again, we go back to the financial statements. We look at their quarterly, annually reports. Look at their, their future value, their price per earnings, book value. See if that fits in line. Then we start looking at the company presentations and earnings call transcripts. The earnings call transcripts will give you a lot of information on what they're going to be doing in the future. How are the revenues? How is the net income? Just as a whole, what have they done? What are they going to do? Are they going to be working with other companies, merging with other companies? That kind of information. Then you got competitor analysis. Understand, what they're doing differently, right? So you want to look at their competitors. What makes them different, from the company that you're researching, and see how, either they relate or how they differ. And determine fair value, which is, using the intrinsic value formula. And the ratios that we discussed before, I'm not sure why it's on this slide, but the ratios that we discussed, the PE ratios, these ratios are a successful way to predict bankruptcies. You start to realize companies with troubled financial ratios deteriorating rapidly. Once you look, when you have all these numbers lined up, you can really understand how successful, or if their company is a failure with these ratios. And that is it. Any questions for Elkin or I, or anything you guys want to add?
I think they're asking them in chat.
Oh shoot, I can't even see my Discord because I'm recording the.
Andrew's typing.
Oh, there. No.
Yeah, I'm just writing something.
Oh, okay. No, you don't need to use all ratios. To be honest with you, I think PE ratio is completely fine. I use book value, PE ratio, and honestly, looking through their annual reports and looking at what we discussed before, right? So their business overview, their management's plan, their industry trend, those are the main things, to look at when you're investing in stocks. You can get a lot more granular in the financial statement analysis, looking at, research and development, how much they're spending there. But in today's market, it's earnings per debt to earnings as well. Earnings per share, debt to earnings, that is for sure. Good question. No. Technical analysis is also, a key part. I guess for the recording, I should probably say these questions. You don't
Long-term investments, look at fundamentals. Short-term positions, look at technicals.
Yep. And looking for information for looking at long-term is you can actually look at, as far as managing your portfolio, look at the 200 moving average, right? Look at the 200 moving average. If that stock is dropping below 200, you got a problem, right? And especially if you bought it at a higher price, if it can't bounce off that 200 moving average, then you got to ask yourself, hey, like, this stock is not performing too well compared to other companies, right? You would rather pick stocks that are either holding above the 200 moving average as a support, or it's, as you can see, stocks these days where they're way above their 200 moving average. So that's another indicator you can use rather for long term. And obviously it depends on what price you get at as well. Like, usability long term, sell puts to enter. Yep, exactly. Yeah, short term investments, it's gonna be technical, because if you're investing for a stock that's let's say 6 months to a year, that annual report is not going to really mean much, right? Because
that's why a lot of the times, sorry, Kian, you can.
No, please.
That's why a lot of the times we see, oh, Goldman Sachs upgraded this stock. We're like, okay, let's the chart. The stock, like, it's good to buy right now for your long term, but if you want to make a call for like a weekly or 2 weeks or even a month, you need to look at the chart and don't look at the news, of course. But what those things do that I like, news, upgrades, downgrades, is that they bring volume. So as long as there's volume, we take up or down. But I'm not going to go long just because they upgraded. I do want to look, or there's some sort of news or earnings. I do want to see that stock and have it on my watch list because it's going to be moving around. It's going to have volume, and that's what we need to trade options. But doesn't mean that I'm going to pick a direction based on those. The direction is going to be on the chart, candlesticks, trends, price action.
And make sure you're caught up in the news as well. You want to you want to know exactly what's going on, what they're doing, any mergers, any acquisitions that they're doing. If they're involved with they could be involved with your community. Who knows? So PE ratio, doesn't Tesla have a horrible PE, but people still think of long term? Yeah. PE. Tesla actually didn't even have Tesla hasn't wasn't profitable, right? They've been profitable for 4 straight quarters, but again, it's Tesla. Tesla is a cult. It's a cult stock. But then again, that doesn't mean that Tesla's not a bad company. Tesla investors are investing for future. This is a future evaluation of what they're doing, right? They have all these plans for the future, right? They might not be profitable in now, but obviously they're overtaking the electric car industry, right? But they're not even a car company. They're a technology company. So when you hear them saying, "Hey, we're improving our technology," day after day, that's what the investors are paying the higher price for. They're thinking about the future, not the current financials of Tesla, because Tesla is probably spending so much money on research and development, right? Or and they're honestly probably not. They're not selling a lot of cars to where they can become profitable, but these last 4 quarters they were. But in general, it's more about the future of this company.
Yeah, I was going to say something about upgrades and downgrades.
Mm-hmm.
Real quick, is that just because you hear somebody upgraded or downgraded a stock doesn't mean that that's actually a value or it's not a value.
Exactly.
If you do your own research on these long terms, there's plenty of stocks that have been upgraded and then they crash in no time from that upgrade. It happens. So there's something that they didn't catch.
Exactly. Yeah. Do you search up the news for each stock daily, especially that is on your watch list? Absolutely. Absolutely. I know. So TOS, I know you don't have TOS, but usually brokers have a tab, like a watch list section, where you can connect the stock with a news related tab. So any news that's related with that stock in your watch list, it will show up. But it doesn't matter. If you have 10 stocks in your watch list, let's say you're using Yahoo Finance as a watch list, you should know exactly what's going on with these stocks, right? For the next morning, the night of, whenever, right? So you have to know exactly what's going on, because one piece of news could either, it could change the whole thing, right? And yeah, and again, yeah, upgrade means, yeah, there you go, Borax. But always, make sure you're up to date with the news of the stocks. Not like Market Watch or what's that? There's this one website where like they give out these crazy opinions on some stocks. Can't think of the top.
Citron.
Seeking Alpha.
See,
CNBC.
yeah, CNBC. You listen to Kramer, then you could be lucky on some of them to get.
Sites like Seeking Alpha, Investors Place. There's a bunch of different ones, but you have to take them with a grain of salt, because there's going to be, for everyone that's listed as a positive, there's going to be 1 or 2 listed as a negative for the exact same stock.
Exactly.
So you still have to
Also
do your own
make sure
research on it.
You know who's doing the upgrade or downgrade. My favorites are JP Morgan and Goldman Sachs.
Absolutely. Yeah, those are
Yeah,
the most reliable.
those are the most important ones.
Yep, you got exactly. You got JP Morgan, Goldman Sachs, even Merrill Lynch is also good. Bank of America.
Yeah.
The big ones. The big ones are good. You don't want to see, like some small, investment bank saying, "Oh, we're," or like an investor saying, "Oh, we're downgrading Tesla to $90." Some people honestly they don't
JP
know these
Morgan.
people. Yeah, JP Morgan sometimes even does it, right? But there's some
JP
random.
Morgan's price target for Tesla is 90 right now.
Yeah, and some people listen to these random investors on the internet and they get scared and they sell out their shares. They move on to the next, and next the stock doesn't care. The stock really does. Look at Tesla. Tesla's been trying to get downgraded for how many months now? How many years? They don't care.
But if you do your analysis and it tells you not to be in something, trust your gut.
Exactly.
Because otherwise you'll always be second guessing yourself, and you'll be looking to sell it every time that some little tick happens in the market.
Now you got stocks like Apple, you have Microsoft, Google. These well-established companies. There's really not the downside of investing in these stocks, right? These are the biggest stocks in the world, right? So don't take a lot of time analyzing the Apples, the the Googles, the Amazons, right? Those are all, like, you should have those in your long term for sure. It's the stocks like, Square, the newer kind of companies, like Neo, these kind of companies, right? Even all these SPAC companies, they could be, backed by big investors, but just do your due diligence, just like anything else. The call flow is black box, so we use black box. We also have that option sweeps tab where it does pull up the feed from black box. If you want like a picture of the flow, you can always tag us and we can send it out to you guys. But yes, the software company that we use is black box. Oh, all right, man. Good luck on your final. Good luck.
What?
Would you say that because it is psychological? For what?
Upgrades and downgrades.
No.
He's asking that.
Yeah. No, it's a good question. I don't think it's psychological. I mean, they run through their valuations, right? So they go from the finances, they go from industry, they go from a competitor analysis, their segment, their management, and that's how they base it on, right? They don't one morning they feel, God, like, man, Tesla is just way too high, so I think we're gonna downgrade them. It's multiple factors. You got to make sure who's on their executive team. Why are they good? Why are they not that good for the company? The segment that they're in, how are they performing? How are they performing against the industry? The same industry that they're in. So they go through a whole process of analysis to to send out these upgrades, downgrades, hold, overweight, those kind of things. But yeah, no, yeah, that happens. HD recently got an upgrade and then started on a downtrend short term. That's exactly why you don't. Apple gets upgrade. Doesn't mean that it's gonna shoot up to 140 the next day. These are just short term trends to just pay attention to have in your back pocket. Remember, if you're doing short term, follow the technical analysis, follow the charts. The long term, when you hear these upgrades, you're going to feel better about your investment. Okay. Where can you find this info? Yeah, anywhere. You can go and just type in JP Morgan, or you can just type in upgrade, downgrades. No, yeah, it's a good good example. Good example. A lot of people go into calls because they hear JP Morgan upgraded Neo to $150. Let's just put all my money in Neo, right? So that's a great example. Don't just go in just because it says upgrade or downgrade. Now downgrade, when you hear downgrade, usually it does affect the price of the stock, for the most part. But this again doesn't mean you're gonna buy puts or calls regardless of their situation. Follow the charts. Yeah, FinViz has a lot of things. FinViz, you can use like short interest and all that too. These are good questions. Good questions. Yes, technical analysis first for short term. 100%. Trend is your friend, exactly. Yeah. So okay, yeah, I can go over it right now. Margin trades. Margin is that you're borrowing money from a broker. Okay? They're going to give you a certain amount depending on your income, depending on your trading status. And when you have that all finalized, I think TD Ameritrade is a minimum of $3,000 to have margin. Okay, but PDT rule applies if you do not have over $25,000. Okay, well, for example, a margin, what they're going to do, you can borrow their money. Okay, you can borrow their money, a certain amount, and they're going to charge you an interest at the end of the year. Okay, I know TD Ameritrade is 8%. But yeah, PDT, pattern day trader. Yes, thank you. And let's say you're buying stock, right, with margin. Okay, they can sell that position anytime they want. Okay, they'll obviously give you a note in the mail, whatever, but they can sell whenever they want, right? So my advice, if you sign up for margin, anyone who here signs up for margin, on TD Ameritrade, whatever other brokers there are, make sure you don't buy stock on margin unless you can afford it. Okay, unless you can afford the interest and all that at the end of the year, because you don't want to start owing money to these guys, right? You want to be able to pay, first of all, you want to be able to make money on those trades, right? So you can use some of that profit to pay off that interest. Okay, so now that we have that, right? So let's say you have 25K or over. Margin is the best way to minimize the cost of your contracts or to sell premiums to buy stocks at a cheaper price. Okay, so let's say you're selling a premium. Let's say you're selling a Fastly put for $2, right? You want that premium to go as low as possible so you can buy it back at the cheapest price. So the difference of that premium that you bought it for and what you bought it back, or what you're selling it for and what you bought it back, is the profit that you're going to make. Okay, that's one thing about margin. Now, when you go to verticals, you can see on my margin account or margin channel where I do call verticals. So let's say I buy a Tesla naked 650 call. Okay, it's just a regular call for March or whatever, a couple weeks out. It's going to most likely cost me, for Tesla, $3,000 to $4,000. Okay, and I'm not going to pay $3,000, $4,000 on just one contract. Okay, so what I'll do is that I will play a vertical. So I'm going to buy a strike. For Tesla, I'm going to buy a little higher than what the what the current stock price is. So if Tesla's at 630, I'll get a 650, 670 call vertical. So I am buying. Yes, selling naked puts is very expensive. Yeah, it can take up a lot of collateral if you have no idea what you're doing. If you don't know what you're doing, you're going to lose a lot of money. But for verticals, you're going to buy that 650 strike. You're going to sell that 670, right? And that's going to decrease the cost of your premium. Okay, so let's say the premium of the 650 call is 13. Okay, let's say I'm selling, the 700 call, for $7 premium. So that total contract is going to cost me $6. So $600, right? Now, with verticals, there's a max profit, right? There's a max profit because you're selling a premium. Okay, so your profits are capped, right? But you're risking less and you can still make a lot of money, right? And for butterflies, and it's the same thing for puts. It's the same exact thing for put. You can get a 600 put, let's say you're playing Tesla again, a 600 put you're buying and you're selling a 580 put. Okay, it works the exact same. Instead of buying, $3,000 600 strike put, you can get a vertical that will cost you maybe half or whatever, however wide your vertical is. Remember, the wider your vertical is, the more expensive it gets. And for butterflies, it works the same. But butterflies is that you're buying if you're playing a bullish butterfly spread, right? A call. You're buying a strike, you're buying a call, okay, at the strike. You're selling 2 calls at a higher strike, and you're buying another call at even a higher strike, right? And we're going to get into more, in more detail. I'm just giving you the basics. And butterflies are great for low risk, with a high chance of, not a high chance of making profit, but you can make, a good amount of money without spending a lot on that contract. Like AMD was a great example. Drew. Drew played an AMD butterfly that I alerted. I think it cost us $46, per contract, or 46 cents equals to $46. So he bought 50 contracts, right? That thing went up to over $1, I think. So he made a good amount of money, but he didn't spend as much. But if he got a naked AMD, in the money call, that would have cost him, per contract at least $4 to $5, per contract, so 500. So butterflies is, again, it's a great way of, not spending as much on the premium, and had a chance of making a good amount of money. Low risk, much higher chance of hitting big, right? So that's margin. It's just you're selling a premium as well, and then it gets more complex. Like you got the iron condors, you got diagonals, calendar diagonals. But I don't do those. Those are just okay. So what is the exit plan when you're in a butterfly position like what you just described? So the one thing that you got to see when you're in butterflies, you'll notice the premiums, they move very fast. So you're trying to fill, obviously, at the limit, right? You're trying to fill at the highest price, but it moves very fast. So what you're going to do is just slowly go down, lower and lower, right? Now, you always want to close that butterfly before expiration, because let's say you're in the money, right? If you're in the money, you're in between, you're going to get exercise, and it's going to cost you a lot of money. See, if someone's playing an Amazon vertical or butterfly, right, or even a Tesla butterfly, you're going to get assigned 100 shares. So I never leave a butterfly open unless that butterfly is, it's not in the money, it's way out of the money, it's not, not profitable at all, right? It's just going to go to zero. But always sell it before market closes on expiration if you're holding it to the last day. You don't want your short position. Nope, no, you don't. You don't want your short position in the money. Yep, absolutely right. Yep. Good questions. Good questions. So what will be the max profit you exit when the price approaches that short strike? Yep, exactly. You mainly want to pin right in between the second and the third leg. Like Seaskin and I played a Netflix butterfly. At the end of the day, that thing pinned right at 500, and that was our middle strike, I think. Yeah, I think so. And you could have gone max profit. A lot of typing. I think I know you guys have questions. Okay. You make more money than just buying the naked call at what would be the short strike in your example. So, not necessarily actually, because if you have a naked call, if you have a naked call, right, there's no cap, right? Because you're not selling any premium, right? You have an exponential amount of profit that you can make on that, naked call or put, right, until your expiration hits, right? With butterflies, you're going to have a max. But doesn't mean you're not going to make, you know, a lot of money, you know, but yeah, in my example, exactly. Yep. Yeah, in that specific example, that is correct. Of course. No problem, Alliance. Hopefully it helped. Yeah, get some sleep.
Crazy.
Dedicated. I love it.
Man's already gone through enough with Arsenal. Stays up for us.
Wait, he's an Arsenal fan?
Yeah, look at his picture.
I'm a huge
Right.
Arsenal fan. I didn't even notice. I'm a huge Arsenal fan.
Man, I feel bad for you guys.
I know. We've
You're
gone
fighting
through
to get out of
some rough
relegation.
stuff. I know. We've gone through rough stuff, but it's okay. Oh, Adam Bagdi. I know. Oh God, what is he? Arsenal too, I think, right? All right. Any more questions? I got time for a little more if you guys have any more questions. Rishi, are you professional? Fresh, you professional? All you guys are professionals. Professional traders now. All right. I think that's good, huh, Borax? Good for tonight.
Yeah, if you think so.
Yeah, I think we're good. Unless, you know, anyone has any questions. See, you got any questions? You good? I know you
got a
do.
clarifying
Bro,
request?
come on. Spit it out.
What? I don't got anything.
You good? All good?
I'm
Fresh?
good for tonight.
All right.
Yeah.
Well, let's enjoy the rest of the night that we have, and then we'll see you guys tomorrow. Let's make some money, right?
Sounds good.
All
Thanks.
right. All right, guys. Have a good one.
See you guys. Great class.
Mm-hmm.